In New York City, I'm Shauna Smith alongside Jared Blickery, and this is Yahoo Finance's flagship show, The Morning Brief.
Investors are digesting the latest read on inflation. Futures are higher while Treasury yields fall after the latest data show that PCE prices, they rose at the slowest pace since March of 2021. So let's get right to it. The three things you need to know this Friday morning. Yahoo Finance's Jennifer Schonberger, Madison Mills, and Josh Lipton have more.
Stock futures moving higher after a fresh reading on the Fed's preferred inflation gauge showed inflation didn't pick up in the month of June, but didn't fall either. The personal consumption expenditures index clocked in at 2.5%, and excluding those volatile food and energy prices, grew at 2.6% on a core basis. That's 0.1% higher than estimates and holding the level of 2.6% in May. This data likely paving the way for the Federal Reserve to open the door at its policy meeting next week for a rate cut this fall.
And crypto is surging, the market anticipating future gains, with former President Donald Trump set to speak at a Bitcoin convention in Nashville on Saturday. Despite once calling Bitcoin a scam back in 2021, Trump is expected to deliver a supportive speech on the digital currency. The price of Bitcoin is still moving to the upside, up nearly 5% ahead of that speech. We'll have live coverage in Nashville on the event.
And Apple struggles to sustain its popularity among Chinese consumers. The company has lost its crown as one of the top 5 smartphone sellers in China, according to data from IDC. Apple saw sales of its iPhone in China fall over 3% in the second quarter from a year ago.
And this is our top story of the day, the latest inflation data supporting the narrative that inflation is easing. PCE, the Fed's preferred inflation gauge, rising 2.6% on a core basis in June from a year ago. That's just slightly above expectations, and it leaves the door open for a widely anticipated interest rate cut in September. Yahoo Finance's Jennifer Schonberger has the details. Jen.
Hey, Jared, good morning and happy Friday. That's right. This fresh reading on the Fed's preferred inflation gauge showed that inflation didn't pick up in the month of June, but didn't fall either. And this likely opening the door for the Federal Reserve to set the stage at next week's policy meeting for a rate cut this fall. Breaking down those numbers, the Fed's preferred inflation gauge, known as the core personal consumption expenditures index, which excludes those volatile food and energy prices, showed inflation grew at 2.6% in June. That's 0.1% higher than estimates, and holding the level of 2.6% in May, but down from 2.8% in April. I will note this was also the slowest annual increase in 3 years. Still, the print shows, as I said, inflation is not picking up. This goes in line with the narrative that the Fed wants to see. The Fed wants to see more than a quarter of good inflation data. So this keeps a cut for September in play, while likely allowing Fed officials to look at data for July and August to ensure that inflation is still continuing to come down before they opt to cut rates in September. And indeed, we were starting to hear encouragement from Fed officials leading up to this number last week ahead of the blackout period. Officials encouraged by the latest inflation numbers in the second quarter. Fed Chair Powell himself said last Monday that inflation readings, quote, do add somewhat to confidence inflation is moving toward the Fed's 2% target. Those comments building on ones he said before lawmakers in the House and Senate that inflation numbers have, quote, shown some modest further progress and that more good data would strengthen our confidence that inflation is moving sustainably back towards 2%. Now, Jared, some investors think that the Fed has enough data to cut next week. That would be very much out of character for the Fed. They are being very cautious about this. They don't want to make the wrong move. Investors pricing in this morning odds of a 90% chance that the Fed will cut rates in September, with a second rate cut likely coming in their minds in December. Back to you.
All right, Jen, thanks so much for breaking that down. Let's take a closer look at the market's reaction to that data print that we got out here this morning. Again, PCE coming in line with expectations on that headline number. Core on a year-over-year basis, slightly hotter than what the street had been anticipating, but not enough to really to mark a reversal here in futures. You got futures moving to the upside still. You got the Dow on track to open just over 200 points to the upside. You've got the Nasdaq also pushing higher here in pre-market trading in the futures, and the S&P also moving to the upside. In the Treasury market, we're seeing a bit of a pullback, it looks like, in yields. We have prices moving to the upside. But let's take a look at what the movement has been in the market this week, because a bit of a different story than what we are seeing play out in the market here this morning on a futures basis. When you take a look at the 4-day chart and the performance that we have seen since the start of the week, you're still looking at a decline for the Nasdaq 100 of just about 3.5%. When you flip it over to the S&P 500, looking at a loss of nearly 2% over the last 4 days. And when you take a look at the Dow, again in the red for the week, off nearly 1%. So again, we have seen this reversal, much of that being attributed to this rotation out of the larger cap tech names into some of those underperforming areas of the market, which again explains the reason as to why the Nasdaq 100 is off such a significant amount when you're talking about those losses of just about 3.5%. So again, the market's reaction to the PCE print this morning, largely positive, but lots of questions about where exactly the market is going from here. Let's talk about how the Fed factors into all of this with that latest inflation data coming in line with expectations. Could this pave the way for the Fed to cut rates this fall? Joining us now, we want to bring in Michael Gapin. He's Bank of America Securities Head of U.S. Economics. And Michael, it's great to talk to you again. So what do you think of this print and what it might tell us about the timeline for the Fed?
Well, I think you characterized it quite well. I think this is another bit of evidence, and we knew most of this data coming into this report because we had the CPI and the PPI print. So it's no surprise where this number landed, but it is another bit of evidence for the Fed to say, yes, the upside that we saw in inflation in the first quarter was largely an aberration. It did not break the disinflation trend. Inflation appears to be decelerating gradually in the direction that the Fed wants. So now it's a question of how much evidence does the Fed need? When does it get that evidence? And when does it act? So I do think it affirms, as you said, the widely held view that the Fed will be reducing rates later this year. And I think next week, it can tell us, yes, it has gained incrementally more progress. We're moving in the right direction. We're getting closer, but we're not there yet.
Let's talk about some of that evidence that might roll in. We just got the latest inflation stats today, but we got 2 more job reports before the September meeting. And I believe, I've done the calculations, if the unemployment rate takes up to 4.2%, that triggers the SOM rule, recession warning indicator that we are actually in recession. Do you think that just gives the Fed that much more credibility to raise rates in September? And then what if we don't get that threshold? What if the labor market is still relatively robust and we don't get that critical SOM rule trigger before the September meeting?
Right. Well, certainly the Fed has changed their tone in recent months. It's now a much more balanced reaction function. It's not just about inflation. The Fed is saying the labor market is back in balance. So further increases in the unemployment rate would tell the Fed that slack is appearing in markets. And reinforce the view that inflation should come down. Now, I disagree kind of about using the SOM rule in this particular cycle, and so does Claudia. I think the unemployment rate is rising largely because growth in the labor force from immigration is outpacing labor demand. It's not a story about layoffs and rising unemployment because firms are cutting back on employment and engaging in kind of large-scale cost cutting. So I don't think the SOM rule applies in terms of recession risk. But I do think if the labor market is normalizing, employment growth is moderating, and strong inflows into the workforce mean the unemployment rate backs up, that can reinforce Fed cuts. I would argue it only reinforces gradual cuts, not kind of the deep and rapid cuts you might get in a recession.
Yeah, Michael, what do you think the pace of those rate cuts are likely to look like? We talk so much about when the Fed is going to start cutting, but I think what matters more here to the street, and I know you've written about this, is more so the pace of that and what that more realistically or accurately could look like.
Right. Very, very quickly here, it's going to shift to pace and endpoint for the market. I think at least initially, the view will be it's a quarterly cut cycle. So a gradual cut, it's a normalizing policy rate following inflation down. Inflation's decelerating gradually, so cuts are likely to be gradual. But obviously, the further you look out, I mean, we can write down these kind of stylized baseline forecasts that assume a lot of things work out well, and I still think that's right. The economy just, though, it rarely evolves in kind of these straight line, smooth fashion. So the further you get out into 2025 and you're past the election and we know kind of what policies we're getting, maybe the view's different. But I think initially, as we look into the rest of this year and perhaps the early part of next year, I think cutting quarterly makes the most sense from the Fed.
We've been talking about inflation, labor market. Anything else on your radar in terms of data that we haven't really touched on that you think is important to the calculus at the Fed?
Well, I think that part of the calculus in markets and at the Fed is, as you have identified, what is the real risk of a sharper slowdown? Is a normalizing economy following a pandemic the same as a weak economy? And I think that the GDP numbers yesterday should assuage some of those concerns that we're in the midst of a more rapid slowdown. I still think the economy is healthy, and I still think a normalizing labor market isn't a weak one. So the key here for me is to say employment growth should be slowing, but that's not because we have overhired and firms are ready to pare back. Employment growth should be slowing because we've caught up to where we want to be. That's a very different dynamic. So I do think that, at least in a risk dynamic story, the GDP data should give the Fed less concern about a sharp slowdown in the economy.
Resilience is the key here. Thank you, as always, Michael Gapin, BofA Securities Head of U.S. Economics. And crypto is surging. Markets are anticipating more gains to come this weekend. Price of Bitcoin is up, 5% to 67,273. This is ahead of former President Donald Trump's speech at a Bitcoin convention in Nashville tomorrow morning. And Yahoo Finance's financial correspondent David Hollerith joins us live from Nashville right now. Dave, I'm seeing a lot of excitement on X and other social media networks. People are saying, all right, we got those Bitcoin highs, all-time highs in sights now. What kind of excitement is there on the floor?
Hey, Jared, it's still early. The programming today and goes through the day, and the big headliner is going to be RFK Jr., the independent presidential candidate who's speaking at 4 p.m. But easily the most anticipated speaker I've heard from conference goers so far is going to be Donald Trump, who will be speaking on Saturday. And Trump obviously has more recently, since the spring, we could say, embraced cryptocurrency, and he's made it a part of his platform. We've heard a lot about what the crypto industry doesn't like about the current administration regarding regulation. We know a little bit less about what Trump is willing to offer the crypto industry. And there's a whole question of donations from the industry to his campaign. And then in addition to that, what a crypto vote is worth. And, you know, in the meantime, we're waiting to hear from Trump to explain exactly what we can expect is in store for crypto if he were to be elected. There are rumors and rumblings of some additions to Trump's wider economic policy that include crypto. We really don't know what that is yet. But of course, there's plenty of hype, and this comes after the ETFs, Bitcoin and Ether earlier this week have had phenomenal inflows for exchange traded products. And so this is sort of a next step touchstone moment for the industry. And that's going to be what we're going to be paying attention to the most. What Trump says about cryptocurrency, more than anything, whether or not he sort of gives it that badge of legitimacy that is so wanted for the community after, you know, years of being seen for the scams that are inherent in the industry and also prior uses.
David, there's lots of excitement, I think, within the crypto community, maybe of what a Trump presidency could mean for the industry. I'm curious what you're hearing about Vice President Kamala Harris right now, and any sort of insight or rumblings that you've heard so far at the conference of how they're viewing a potential Harris presidency.
Yeah, Shauna, she obviously was asked to attend and declined, and that's coming from the conference organizer, David Bailey. He tweeted that earlier this week. It's worth pointing out, too, that she has a fundraiser in Pennsylvania on Saturday. So the idea of her coming in and speaking at the crypto conference is not as simple as her not liking the crypto community. Largely, everyone I've spoken with has been open to hearing what Harris has to say about crypto. She obviously is quite busy stepping up her campaign this past week. But I think people are still willing to give her time. That being said, a lot of the policies that Trump is sort of talking about, lower tax cuts, more friendly regulatory environment, it does seem less to be Democratic leaning, or Democrat leaning, excuse me. And so, we'll definitely want to hear what she says. But there is a minimum she can give that the industry doesn't have that I think would please them.
All right, David, always great stuff. Thanks so much for your insight, and good luck this weekend at the conference. That's David Hollerith. Thanks, David. Well, Apple facing more problems in China, seeing shipments of its iPhone in the region fall over 3% in the second quarter from a year ago, knocking it out of the top 5 smartphone makers in the country for the first time in 4 years. Now, these numbers are the latest that we're getting. This time, it's data from IDC. Now, the tech giant also reportedly reducing the price of its iPhone Pro models in India by 3 to 4% after the country slashed import taxes. That's the latest that we're getting out of TechCrunch. Well, let's start with some of the numbers here, Jared, that we're getting out of China, because it's consistent with some of the estimates that have been published earlier. We had a drop of about 5.7%. That was estimated by Counterpoint. Canalys had a reported 3.9% decline. So at least what we're getting from IDC, I guess you can view as a bit of an improvement since it was only a 3.1% decline. But obviously, China, a critical region here for Apple. And of course, this begs the question just about the future of Apple in China when we do see this rise of domestic players.
Yeah, I mean, if you're in China right now, do you want to scrap your existing phone, turn it in, and get the latest one? The price premium on Apple phones is still there, but is the feature premium still there? And the competition has gone is up there. So you take a look at Huawei, Vivo. There's another company, OPPO, that, I mean, China manages to produce some brands, and this is in the EV space as well, that just kind of become giants overnight, but a lot of people in the West haven't heard about. So it's a very competitive marketplace. Apple doesn't really have the edge that they used to, but they do have the strength of their brand behind them. So I want to show something on the Wi-Fi Interactive real quickly. I'm going to show a chart of Apple. This is year to date, and you can see Apple is in the midst of a 3-month uptrend here, but that was after about the first 4 months there were negative. And now I'm going to show you something else. This is Apple's seasonality, what the stock tends to do going all the way back to inception, 1982. And this shows that in August, this is one of the historically strongest months. And this precedes the iPhone cycle. It precedes everything. It goes back to the 80s. And for whatever reason, August tends to be a strong month. September, not so much. That's when you kind of, that's the aftermath of whatever announcements. And then October, it's off to the races again. So this is just a tendency, but I wanted to throw that out there.
Yeah, that's a great point. And when it comes to that second story that we're tracking here, the lower prices in India, I bring this up because there's so much talk about tariffs, increased tariffs here in the U.S., what that could potentially mean here for prices. We're seeing what it ultimately means maybe for iPhone prices over in India. And I bring that up because they are inflationary, but India just announced that import duties on mobile phones and some key components are going to be reduced from 20% down to 15%. Now, as a result of that, TechCrunch is now reporting that they are going to lower the price of the iPhone 15 Pro and also the Pro Max models. The first time Apple has ever reduced prices of the current premium models in the country. So that is significant. We talk about the fact that Apple is expected to be one of the beneficiaries, one of the main companies to benefit from this move here in the lowering of import duties. You can see what it means then for consumers in India. All right, a developing story we are tracking. France's rail network facing major disruptions today ahead of the Olympics opening ceremony. Officials announcing fires were set at 3 locations surrounding the train network, specifically targeting lines that serve Paris from the north, the southwest, and the east. Officials say the cables were cut and burned and will take days to repair. The outage is expected to impact about 800,000 people this weekend. The opening ceremony is still set to begin at 1:30 p.m. Eastern Time today. We'll bring you updates as the story develops. We'll be right back.
Time for some trending tickers. Shares of 3M in the green after adjusting the bottom end of its full-year outlook and reporting second quarter sales above expectations. These are the company's first results under its new CEO, Bill Brown, who took over for Mike Roman on May 1st. And so this is kind of a leaner company that we're dealing with now. They recently spun off. From another company that was a medical operation, and now the maker of Post-its is just kind of reorganizing a bit. Vital Knowledge says that there's strong upside on the earnings. Barclays likes the strong margin performance. They also like the increased buyback activity. So all in all, it looks like they're kind of on the right track here, but it's still in the early goings with the new CEO.
And the new CEO saying in a recent interview that sales growth obviously remains a priority for him moving forward at his new time here at the helm at 3M. He said he's also plans to reduce the organization's complexity, and he used this as an example that a command strip, I'm a big buyer of those, pass through 5 factories and 2 distribution centers before it gets to the customer. So he's looking to streamline. Exactly. Who knew? He's looking to streamline some of those businesses there, which does make a heck of a lot of sense if you're looking to cut some of those costs. And he went on to say in this interview that they're going to continue to take a fresh look at what cost is embedded in that complexity. He also added that the company's challenges is that it's also looking for a new CFO after announcing earlier this month that their CFO would be departing. So again, some questions about who is going to take over that role. But again, this first earnings report with him as the CEO, you're looking at a bump up in the stock with 3M shares rising. They are encouraged by some of the initiatives that have already taken place under him as
leadership.
CEO. Yeah. Leadership. There we go. The word I was looking for. All right, let's take a look at Deckers Outdoor. That's surging this morning after lifting its full year profit guidance. The company CEO saying, quote, Hoka and UGG continue to drive a robust full price demand in the global marketplace. So you're talking about the fact that chunky sneakers are back in with Hoka. They're flying off the shelves. You also talk about that Uggs are back in fashion. I've been a buyer of both of these products here over the last several months, so contributing to that. But Ugg sales, this really jumped out to me.
Yes.
They rose 14% in the most recent quarter, less discounting. The brand's also taking share of the sandal market. So again, this rise that we're seeing in the popularity of Uggs once again, this continued steady outperformance in Hoka clearly Deckers is benefiting from that.
It would be amazing to me if Uggs is somehow encroaching on the Skechers market, or, I don't even know. I don't even want to comprehend how that could work. But I do have some analyst commentary. Here is TD Cowen. The analyst remains impressed by the, quote, consistency of innovation, segmentation, and accretive direct-to-consumer growth, which should continue to support a robust growth profile into future years, saying the guidance increase, that was bigger than expected, and he raised the price target to $1,055 from $1,039. Citi calling it another big beat. And then here's another quote. Despite market fears of a slowing macro, management gave no indication of a change in the environment, suggesting earnings upside is still likely this year. So that a little bit of a statement on the economy as well. And, just kind of taking all of these earnings reports in stride that we've seen this week, the consumer does appear to be strong. The economy appears to be strong, and some of the cracks that we've seen in the labor market haven't necessarily been showing up in the earnings reports.
All right, let's take a look at Dexcom, because this stock really on the move here ahead of the open. Shares are plunging. You're looking at losses of nearly 40%. This comes after the company missed second quarter revenue expectations. They lowered their full year guidance. They said that they are now expecting revenue of between $4 billion and $4.05 billion, essentially $4 billion. That's down from last quarter's forecast of $4.2 to $4.35 billion. That was a range that they had initially given. When you take a look at the fact that shares are off 40% because they are cutting their outlook so substantially, one of the questions is as to why. What is the clear driver of this? And I was taking a look, our executive producer was taking a look at the earnings call after we were discussing this in the break, and there was some questions about the impact that maybe GLP-1s are having on this company. And
that was your first reaction, to be fair.
It was. I was just saying, I wonder if there's any correlation. To be quite frank, we don't know if there's any correlation yet. The CEO was asked about this, and he responded by saying, short a large number of new patients as to where we thought we will be at this point in time. He also went on to say that sales force reshuffling, which led to changes in geographic coverage, was more dramatic than expected. Physicians were now dealing with different reps. So he didn't say no, he didn't say yes, but there are questions circling as to the impact that maybe this company is having as a result of GLP-1s.
Yeah, we'll just throw it up in the air right now. Want to quote JP Morgan here. They cited severe and sudden near-term challenges. Near-term challenges. They lowered their price target to $75 from $145, so basically cut their price target in half. Citi labeled the guidance cut as, quote, clearing the decks. So this suggests a reset of expectations. That means that maybe going forward there is going to be a new plan of action, but I think the plan has to be made known to investors. Especially, is this an idiosyncratic story, or is this, a market story about GLP and maybe a little both? Yeah,
exactly. Again, they're the maker of the glucose monitoring devices relied heavily upon by diabetics, so that's the connection that they would have here to the GLP-1 medications. All right, coming up next, we're just a couple of minutes away from the opening bell on Wall Street. We're going to break down some of the biggest movements that we're seeing ahead of the open. Looks like we're seeing a bit of a bounce back here ahead of the open this Friday morning. We'll be right back. And that's the opening bell on Wall Street. We got confetti at the Nasdaq. Also some
Fun
excitement from Betway at the New York Stock Exchange, kicking off the final trading day of the week, doing a check of the markets. Now the movement at the open coming on the heels of that PCE print that we got ahead of the open here this morning. I believe we are looking at gains at the open. You've got the Dow moving to the upside, opening up nearly 300 points here in a rally. And you're also looking at maybe a bit of a bounce back here, Jared, in the tech space.
Yeah, it's going to be interesting. Let's track and see where we are, the 5-day tally for the week, and almost back to break even for the Dow. So a little bit of upside, more downside. Here's the Nasdaq Composite down 2.25%. So that is the loser so far. S&P 500 off about half of what the Nasdaq was. Want to check out what the Russell 2000 has. Now, Russell 2000 exploded last week, and it's been adding to its gains this week. And finally, we got to check out the S&P 500 equal weighted. So this is actually over, well, let's see. Well, we're getting mixed results there. Maybe it's not getting that first print. But anyway, we've seen kind of a dichotomy between the S&P 500 market cap and also the equal weight. Also want to get a check on the sector action. And here we can see communication services. That is the home of Alphabet and Meta. That is up the most, up 1.4%, followed by industrials, tech, consumer discretionary, all of those outperforming. And let's leave it with a look at the Nasdaq 100. And more green than red. Microsoft, Alphabet, a little bit down, but NVIDIA climbing closer to that record high. Let's just see how close it is. It's been almost 30 days, and I know people are counting. This correction here was 29 days, so people are counting down. Is it going to be the same number? Anyway, we're getting there. So lots of expectations for NVIDIA as well.
Impressive. You knew 29 days right off the top of your head. All right, let's talk about this movement that we're seeing here at the open, because we are seeing a bit of a rebound in the tech space now that move higher across all three of the major averages, coming on the heels of the latest data that we're getting on inflation. The Fed's favorite inflation gauge, PCE, coming in line with expectations. That core year-over-year number slightly higher than what the street had been forecasting. Let's talk about that and more. We want to bring in Adam Hetz. He is Janus Henderson, Investors global head of multi-asset. Adam, it's great to have you. So talk to me about how you're looking at the massive sell-off that we had this week, a lot of that being led by the rotation out of those larger cap names, and maybe what that signals about the volatility ahead.
Hey, good morning. Thanks for having me. And yes, happy Friday. After a pretty dramatic week, we sort of went from Goldilocks economy back to growth scare. And now it seems today we're wrapping up the week back in, I think, Goldilocks mode. And so we had PMIs, we had GDP, we have PCE today. So it's enough economic acronyms to make any normal person's eyes glaze over, I think. But the bottom line here is that we've got the economy chugging along. I think we had a bit of a reacceleration earlier in the year, and now we're in this mode of slowly slowing, which is where this Goldilocks optimism is coming from. So I think all systems go, green lights from the economy as far as the news this week. It's still encouraging. When we're talking to our clients, though, and we're thinking about the market returns that have accompanied this economic optimism, there is a big disconnect between what the economy is telling us and what the market seems to be expecting and pricing in. And that's a source of risk for us as we're thinking about the next 6 months in market returns. Yeah,
that dichotomy, there always seems to be a split between the Main Street and the Wall Street economies. What are you expecting from the Fed next week? The consensus is nothing happens in July at this meeting that we get next week, but it's setting up for a September rate cut. And there's a lot of speculation about that. Do the numbers from this morning kind of feed into that? What else would you want to see personally to see that September cut?
The numbers feed into it, it helps. And look, rates and inflation are some of the hardest to predict parts of the market, and a market that's overall impossible to predict to begin with. I think in the comments that we'll look for next week from the Fed, the market's at least expecting a 90% chance of a cut in September. And there was a little bit of a push and some discussion around July cuts, but it seems like the mix of data seems to be consistent with that September cut. I think you want to see NFP, non-farm payrolls, come in next week, again, with that slowly slowing pace, not too hot, not too cold. But again, it goes back to this is a market that is essentially, for better or worse, pricing in these Goldilocks outcomes. So it's a very sensitive market. It's a nervous market, and it's a very expensive market. So if we see any blips in the commentary, we see any blips in non-farm payrolls or the next CPI print, that's going to lead into the September meeting. And then you can probably expect some pretty violent market reactions. And we saw that this week. We're seeing 1-2% swings easily within a day when this Goldilocks narrative gets disrupted.
So what does that essentially then tell us about this rotation that we have seen out of tech? Is there more downside ahead for what had been the leaders within this most recent leg higher? And if so, what do you think the degree of that downside could potentially look like?
Well, the degree of the downside comes from this historic level of concentration we've all been living in and frankly embracing for the last few years. And that concentration within the US, it's the US tech sector making up over 30% of the US, the Magnificent Seven piece, the sector at least. So there's that. And then it's just US making up a historically large part of the rest of the developed world. So there's a lot of eggs in one basket when it comes to the market right now. Then you look at overall headline valuations, sourcing from that concentration of those really high multiple names. Now you've got overall multiples on the S&P 500 running at levels that are above 20. I mean, once you get above 20, think about long-term historical multiples closer to 17. In other words, you can easily see a 10 to 15% derating if this narrative gets disrupted. But this gets back to the point of the economic background feels solid and stable, and we're not seeing those fractures or cracks in the surface of the economic foundation yet. So when we look at that 10 to 15% derating we could potentially witness in the S&P broadline, then you could also see potentially, if tech earnings don't go as hoped, you could also see some earnings expectations come down as well, which could compound on that 10 or 15 drop, and that could very easily spell out a bear market technically at 20%. So I'm not saying that that's our base case, but we're staying really close to our clients right now. We're focusing on the economic optimism, and we're focusing on the fact that the market is relatively expensive, and you probably could expect a correction to that between now and the end of the year. But going back to your question, luckily that spells a lot of opportunity for the market broadening and for investors that have wanted to diversify away from those concentrated expensive names for so long, but have paid a price for it.
Yeah, I know
now you're getting some value for that.
Yeah, I know you like small and mid caps, so that's where I want to get you out of, and Europe as well. So last question is, where do we put this money here?
Yeah, so what you've seen over the last month is you're almost getting this double-digit dispersion from the small and mid-cap space compared to the large-cap names. And so that's what we like to continue to see. We love the broadening. The catch there is we're going down in cap, going to the other 493 in the US. 40% of the small cap universe is unprofitable. And these are also the more cyclical, value-oriented names. And the same goes for Europe. So as we're diversifying out of these bigger growth-oriented names, we have to remember those are more resilient in that rare case of a hard landing type outcome. So as we are diversifying, going down in cap, going ex-US, we're looking for growth. We're looking for quality as a bit of a mitigator as we add more cyclicality to a portfolio in what's still a late cycle environment.
All right, appreciate your thoughts here. Thank you, Adam Hetz, Janice Henderson, Investors Global Head of Multi-Asset. And it has been a tough week for automakers after reporting earnings. We're going to discuss who is best positioned for the second half of the year with an analyst. That's up right after the break. It has been a tough week for automakers. Ford and Stellantis reporting disappointing earnings this week, sending their stocks tumbling. And despite GM beating expectations, its EV expansion delay is weighing on its stock. To discuss which car company is best positioned for the rest of the year, Daniel Roska, Bernstein senior analyst, joins us now. And just give us your big picture overview of the results that we got this week. Any surprises?
Hey, good morning, Jared. Thanks for having me. Look, I think first half and Q2 actually was not terrible. What really spooked investors this week is the outlook into the second half, where companies across the board signaled that they expect a weakening U.S. consumer landscape.
Dan, when it comes to what that tells us, maybe once you dig into these reports, there was a lot to like within the GM report. You take a look at investor reaction to Ford. It looked like something was missing there because we didn't have that beat and raise that it looked like the street had been anticipating. What does that then more broadly tell us about the landscape ahead for so many of these traditional automakers and maybe how tough the road could potentially be here in the short term?
I think, look, two things. On the short term, this is all about earnings revisions, and what we heard this week will take earnings down, and so that's the headwind we're seeing. In the medium term, I think you need to realize that Ford wants to keep the cash to preserve strategic optionality, whereas Stellantis and GM are still distributing a significant amount through dividends and buybacks. And I think if you look out until end of the year into next year, you probably want to have a stock here that's paying you to wait, because it'll take until mid-25 before U.S. consumers wake up again and we get the engine restarted again on autos.
I want to get your take on Tesla. They were able to increase their deliveries to 444,000 units, but there are lots of promises. And bottom line, they sport a 88-time multiple on Ford PE. I'm just wondering, is Elon behaving? Is Elon's behavior justifying that Ford multiple?
I'm going to be careful on that multiple because, of course, there's a lot of enthusiasm around all the things that are not cars that is built into Tesla. And I think that's really what you need to look at. They're trying desperately not to be a car company, quite honestly. The way they talked about Optimus and the other opportunities on the earnings call, right, shows you. I think on the segment of cars, what you got to realize is there's going to be a model refresh in 2026. And the new model, kind of Tesla 2 or whatever the name will be, likely is 27 and later. And that means any significant volume growth on the key aspect of cars at Tesla will likely have to wait quite a bit. And I think that's really what's weighing on the stock right now. And that's also what our team kind of sees in the future for this company.
Daniel, you characterized Stellantis' quarter as, quote, it's a miss all around and takes us into, quote, uncharted waters for this group. What do you mean by that?
Well, look, we've got one of the best CEOs in global autos running this company, Carlos Tavares, right? He's a master at, the cyclical industry. He cuts costs like nobody else. Yet here we are in the situation where Stellantis did all the wrong things in one quarter, right? They pumped the inventory channel last year. Inventories went up. They had to put discounts back on. They had to put pricing down. They overspent on M&A. They overspent on CapEx, and they basically had no free cash flow in the report. And this is really the first time in the past 3 years that Stellantis has messed up, right? So far, this has been the poster boy of global autos with a very strong track record. And so this raises questions whether the performance of Stellantis, or how much of the performance of Stellantis over the past 3 years was due to the great M&A and consolidation between PSA and FCA they did, and how much was just due to the lack of supply and the supply chain issues we've had driving up prices.
What do you think that then tells us about the price strategy moving forward? Do you think we'll likely see price cuts as a result of some of that weakness here?
Yes, look, if we look at the inventory levels right now, we're about 25% higher than where we should be in the US. And that means everybody across the board, but especially Stellantis in some of their segments, will need to cut pricing or find some way to entice consumers. What we're seeing as a reaction, in addition to pricing, is that OEMs will cut production in Q3. That relieves inventory pressure into Q4. And so if you're looking for a car deal, Labor Day is the day to go. I think up until then, we'll see consumers being in a better place to buy a car, to kind of get a good deal. After Labor Day, you'll see some of those production cuts come through into Q4. And so by the end of the year, I think we'll have worked through this. And again, this is a typical auto cycle. This is nothing to be afraid of, but it does weigh on earnings in the second half.
I'll give you the floor here for the last one. Anything you want to leave investors with here?
Look, I think autos is autos, and the past 3 years haven't changed that. And so it's a cyclical industry. You need to think about the near-term earnings. We think GM here is best positioned to tide people over with a good buyback and dividend strategy. In the medium term, though, we'd flag that everybody, Stellantis, Ford, GM, they're all working on the future platforms, on the electric vehicle platforms, and they will be around. They will be a part of this market. And so in the very long term for investors on autos, which is 3 years, I'd argue these companies are going to be around. They're going to have better earnings than they had 5-6 years ago. And so ultimately, valuations will have to come up on this sector, but that is not something for today. For the next couple of weeks, this is all about second half. And I take a deep breath, step back, look at your portfolio, and if you want to be active, I would look for a stock that's compensating you for to wait, and that's basically GM at this point in time.
All right, Daniel Roscoe, great to have you here. Bernstein's a senior analyst. We appreciate the time.
Thanks, guys.
Let's take a look at shares of Novo Nordisk. They're on the move to the downside, actually down by about 0.7%, despite the fact that EU regulators back the use of Wegovy to lower the risk of major heart issues and strokes in overweight and obese adults. To discuss, we have our very own Yahoo Finance's Anjali Kamlani.
Yeah, that's right. This is good news, of course, for Novo because more of a market for them, but at the same time, more pressure on production for these very same drugs. So the EU joining the UK and the US in approving Wegovy for use for cardiovascular risk. We saw in the phase 3 trial for Novo Nordisk that it reduced cardiovascular risk for death, non-fatal heart attack, and non-fatal stroke by 20% for other major adverse events as well. And this is specifically for overweight adults. Remember, Wegovy is the weight loss drug, not the diabetes one that Novo Nordisk produces. So just another market for Novo to now cater to.
I would call Eli Lilly a mega cap, and we saw some big drops in mega cap stocks this week. $760 billion by the Magnificent Seven in one day, but we're talking about Eli Lilly, $120 billion in one day. Competition is heating up, so who's in that competition space?
Yeah, so Novo also getting a little bit of a hit from that, but Eli Lilly specifically because, to your point, Jared, it is a major a mega cap. It has been on the path, if you will, for becoming potentially the first $1 trillion healthcare company, right? Like that's the thing that people have been watching for this stock in particular. And so what it has, that's why this loss is a little bit more disappointing. $120 billion in value lost on the news that Viking Therapeutics, a biotech, is getting closer to the finish line with its obesity drug. Meanwhile, it has lost 14% in the last 8 trading days alone, but on the upside, 38% up year to date and 80% up in the past year. So on balance, not doing so badly and still managing.
Those are mega cap numbers.
Right.
Exactly. How it got there in the first place.
Right, and it still is holding on to a fairly decent valuation. The market cap is still well above that half billion point right now. So. $500 billion point. So that's, it's still holding pretty well. But it is one of those stocks that is being impacted. Novo is also being impacted. But because Lilly has had so much more going on for it, you're seeing that trajectory.
All right, let's take a look at Weight Watchers because that stock's under a bit of pressure here this morning. It actually got a downgrade from Morgan Stanley. The reasoning behind that, they talked about some of the headwinds from obesity medications, maybe GLP-1s. That has been one of the overhangs on this stock most recently here.
Yeah, and this is similar to the story for Lilly. You're seeing increasing competition. You're also seeing increasing focus on what else is out there, right? We've seen other companies sort of pick up the Weight Watchers strategy. You've got Hims and Hers, for example, that are both offering the GLP-1s as well as the counseling and the guidance. And Weight Watchers try to get into that. They've had a number of major losses in terms of executives. We know Oprah Winfrey left the board. They've also lost another executive as well. The chief medical officer just left. So they've had these concerns about pivoting away from the idea that you don't need to follow the pills, don't need to follow the fads, and can consistently lose the weight. And that has been one of the things that has weighed on the stock. How do they exist and coexist in this world of increasing GLP-1 frenzy? Could it be an overreaction from Wall Street? We've started started to see a little bit of that when it comes to other medical devices, other machines as well in the recent past, all focused on this GLP-1 era. And so whether or not that actually comes to fruition, whether or not that really is a headwind for the company, we will definitely be seeing. But it strikes me as interesting considering the fact that we do see other companies, following that similar strategy, and they're actually up on these news. So will be interesting to watch.
Will be interesting to watch. All right, Anj, thanks so much. Coming up, Coursera's big gains. The stock up pretty significantly here this morning on the back of an earnings beat. A lot of this having to do with excitement surrounding AI courses. We've got more for you when we come back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Let's get to three other big earnings reports that we were watching here this morning. We've got three stocks for you in 30 seconds. Let's kick it off with Coursera. We're looking at that stock moving to the upside, a massive rally on our hands here. You're looking at shares gaining about 53%. This coming after the company beat on earnings expectations for the second quarter. Why? Well, it's actually all about demand for AI. This is an online education company. They're saying that demand for the AI courses is surging. And just to give you a better idea of what that demand looks like, surpassing more than 2 million enrollments in its Gen AI courses here. So again, we're seeing that directly reflected in these results. And again, trading volume really pushing to the upside today, much higher than typically is at the average time for the day.
I am looking at Norfolk Southern, and this stock is also moving higher, about 10% off of a solid earnings report. The company getting a boost from insurance payments to help pay for some of the costs of last year's derailment in East Palestine, Ohio. So this is a company kind of clawing back from that disaster. Morgan Stanley is saying of the results, they were the surprise second quarter beat driven by productivity traction, noting that the company's opportunities and risk lie more on the revenue side than on the cost. Jefferies calling the costs a beat across the board, expressing confidence in long-term margin improvement opportunities. Shauna?
All right, let's take a look at the Chinese EV battery maker CATL. It's seeing its profit rise over 13% in its latest quarter, bucking some of the trend that we've seen from its rivals, at least to some degree. Maybe it is. Shares are up just about 1%, but we do have to put this in perspective because revenue did slide during the quarter. Weaker demand out of EVs is an issue here for CATL and its rivals. It's been hit by the sluggish economy in China. That revenue drop actually deepened from that 10.4% drop that we saw in Q1. Yes, if we want to look at a positive side to this report, it was that profit jump, net profit jumping 13.4% from a year ago. All right, coming up, we have a breaking consumer sentiment data out at the top of the hour. We are going to dive into that and much more next on Catalyst. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. And let's dive into the catalyst moving markets today.
We are getting a fresh read on the consumer right now with July's consumer sentiment crossing the wires. We're going to give you the latest numbers and discuss how inflation is impacting consumer sentiment overall in a few moments here.
And it's been a rough week for tech. The Nasdaq off over 2% in the last 5 days, but bouncing back just a bit this morning. Next week is going to bring a big test for the sector with a slew of the Mag 7 names reporting earnings. We will discuss whether or not this week's selling is the start of a larger rout for tech.
And Vice President Kamala Harris secures a key endorsement from former President Barack Obama and former First Lady Michelle as well. So how does this impact Harris's campaign with about a month until the DNC? We're going to discuss the latest.
All right, we got some breaking news out on consumer sentiment data being released just a moment ago. And it looks like the U.S. For July, the final Michigan sentiment reading here falling to 66.4. That was slightly down from the estimate of 66.5. Expectations index falling to 68.8. That was versus 69.6 the prior month here. The expected change in median prices during the next year, that actually fell to 2.9% versus 3% last month. The expected change in median prices during the next 5 to 10 years, that was unchanged at 3% here. But Maddie, when you take a look at the market's reaction, this is interesting here because you've got the S&P 500 extending gains on the heels of this print. It looks like we're up just about 1%.
Yeah, it's interesting given that we've got just this hugely mixed picture of data, right? You had GDP coming in higher than expected yesterday, 2.8%. It's a growth story for everybody. Then you had the PCE, a little bit mixed, but primarily in line. We'll certainly get into the details under the hood of that data. And then you've got this consumer sentiment data at the University of Michigan falling just a touch below what was at least anticipated here. So what does that mean for the Fed moving forward? And what does it mean about the disconnect that we're seeing between the economic data and the consumer? Is certainly a question that's coming up on a lot of earnings calls. If you take a look at what we've seen in the airline space and some of the luxury consumers as well, and we'll certainly talk about autos today, seeing some consumer weakness wherever you want to look for it. But what does that mean for the broader economic picture? We're going to continue that exact conversation with David Miller, Catalyst Funds co-founder and chief investment officer. David, we love the name of your firm. Welcome to Catalyst here. Thanks for joining us.
Glad to be here.
So talk to me about this totality of the data, not to sound like Jay, but where do you find clarity in what could broaden your thesis on the market?
Sure. Well, you really have two levers that are moving the market in opposite directions. So you have one, which is, can the Fed finally cut interest rates? Can they do roughly about 2 cuts versus having to keep them steady to keep inflation in line? And it looks like they can actually make those cuts, and seeing like 2.6, 2.8% numbers on CPI and PCE probably indicates they're safe to do that, especially now given that they've moving the goalposts. You don't have to hit a 2% inflation target anymore. They're probably okay with something right around 3. It seems like they can safely cut interest rates at this point, and that's because of the opposite moving lever, which is corporate earnings are coming in a little weak, along with the inflation data. So those interest rates being lower, when you have a numerator on the earnings and a denominator on the rates, moving that rate lower, especially when it's unusually high, can justify higher valuations. So it's always hard to evaluate which one is the bigger impact.
David, I'm curious what you make of the market's reaction right here, because we're seeing this leg higher on the heels of that consumer sentiment number. Right now, we've got the S&P up just about 1%. We were moving to the upside ahead of this print. It's important to point out here, but we've really taken this leg higher. What does this signal to you? I mean, it looks like the market's growing even more confident with that September rate cut. Is that the right read?
I think the market, a couple days ago, we had that really unusual hit, which was the biggest hit we'd had since 22. So that kind of gave us a little bit more room where we could bounce back. And then I think you're seeing some of this weak inflation data indicating, inflation growth is actually slowing, that's giving the market more of an all clear signal that the Fed's going to go ahead and finally do it and cut rates. So I think that's more of the response that we're seeing in equities today.
It's also coming on the heels of a lot of downward pressure that we've seen, particularly in the large cap tech space. Do you think that what we're seeing over the past couple of days, is that a rotation out of tech, or is it the beginning of a bit of a rout in the tech space?
So I don't think it's a rout in the tech space. Like if you look at Google in particular, they're trading at probably about slightly under 20 times forward earnings. They're growing revenue about 14%. They had like 29% earnings growth. I think it's pretty unlikely that there's going to be a rout. The only real weakness we saw, like for example with Google, was on the YouTube numbers that came in at 13%. But we're still talking about double-digit growth. The real weakness, I guess, whether you call it auto or tech, was really more on Tesla, where you saw two sequential revenue declines, totaling about 7%, and real delays on whether their self-driving, car service is really going to happen anytime in the near future. So I think it's kind of a bit of a mixed bag, but I don't think we're in for a rout. I think we can still move up a bit from here.
Are you a buyer of tech at some of these beaten down, quote unquote, beaten down levels?
Certainly they're not cheap on an absolute basis, but when you look at how dominant these companies are and how high the margins are and the extent of what I'd call their monopolies, whether you look at like a Microsoft or a Google, I think if you're seeing double-digit growth and that's paired with about 20 times earnings, that's actually a pretty appealing valuation, just given that these are such impressive businesses from that perspective.
You mentioned a couple of earnings. I want to zero in on Alphabet. I know this is a stock that you look at in particular. Did the street's reaction to Alphabet's earnings, that to your point were not that terrible, did that change your thinking on upcoming tech earnings and kind of where the bar is at for those other names?
I think Google's getting a little bit of unique pressure from this concept that maybe AI will replace Google, but I don't think the data is really indicating that. You're still seeing revenue growth, you're still seeing earnings growth, you still see that they're putting a lot of their own efforts into AI. You see that the cost to compute for AI is so much higher than a Google search. That I think it's more a unique issue specific to Google. So I think it was the most recent reaction we had was more off a little bit of weakness on the growth in YouTube.
Outside of tech, where are you finding those opportunities? And I guess what is your recommendation in terms of what investors need to keep in mind heading into next week, which could be a volatile week if it's anything like we saw this past week here with earnings?
I think the key thing for investors to keep in mind is nothing has changed that much. You need to make sure you're focusing on those businesses that have extreme earnings power, that have really dominant franchises, that have big economic tailwinds. And some of that is certainly tech, but you also look at a company like a Visa or MasterCard. Extremely dominant franchises. You have no choice but to work with these companies. Really high margins. Any inflation flows straight down to their bottom line. So I think it's really focusing on those dominant franchises and avoiding those that have kind of been long-term stuck money or even losing on when you look at things more like airlines or auto OEMs, things of that nature.
All right, David Miller, great to have you here on with us this morning. Catalyst Funds co-founder and chief investment officer. Again, great name. All right, turning now to the latest in Washington. Vice President Kamala Harris is securing a key endorsement this morning. The Harris campaign posted a video of the phone call between Vice President Harris and both Michelle and former President Barack Obama. Let's take a listen.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
Oh my goodness. Michelle, Barack, this means so much to me.
Well, with the DNC about a month away, how important is this endorsement? Yahoo Finance senior columnist Rick Newman is with us. And Rick, I'm going to answer that for you. It's very important.
It was also inevitable, but thank you for answering the question, so I don't have to. So the Obamas waited a few days between the time Joe Biden said he was stepping down and the day they decided to make their endorsement of Kamala Harris official. And I guess they did that just give Biden a little bit of breathing room. Don't make it look like they sort of were pushing Biden out the window. So it's all done. I mean, in the big picture here, the entire Democratic Party has very rapidly lined up behind Kamala Harris. Obviously, nobody challenged her for the nomination. And I think for the Democrats, that's good. So instead of fighting among themselves or having some sort of mini primary election in the summer leading up to their convention next month, they are full bore going forward against Donald Trump, and we will see how this accelerates into the convention. I mean, one thing to keep in mind, a lot of Americans are on vacation. It's summer, they're out doing stuff, they're not paying attention to all this drama. That will change in September and October.
Yeah, Rick, it's a good reminder for those of us who, as you have said, don't go out and touch grass and just look at our phones all day. But having said that, we got some big news about new New York Times Siena College poll. I know you've been looking at this, but the gap between Trump and Harris really starting to kind of decrease here. When you look under the hood of that data, what does it tell you about what the path forward might be looking like for the election?
This is going to be a close election no matter what happens. Assuming there's not, some other dramatic surprise, such as Trump dropping out or something like that. But Kamala Harris she's just looking like a better candidate than Joe Biden did. I mean, number one, she's getting sort of what you might call a honeymoon bump here. And I think the big question is this just a quick bump because, some temporary enthusiasm for her, or is she going to be able to sustain it? And that's up to her. If she turns out to be a really great candidate, she will intensify the enthusiasm that has built around her in these first few days. It could go the other way. Enthusiasm could wane. She could make mistakes on the campaign trail. She could run a disorganized campaign. So there's a lot up in the air. But, one of the things I know about Kamala Harris, I mean, at the end of that phone call with the Obama, she said, this is going to be a lot of fun. And she looks like she's having fun. And, she's every time you see her, she's smiling. Whoever sees Trump smile, I mean, he's always scowling and talking about how terrible things are and what's wrong, everything that's wrong with America. My sense is that if she can keep her visibility up and keep that sort of happy vibe going, that might be something voters really welcome at a time when everybody's just feeling so bummed out about everything.
That's a great point there, Rick. We do need some more optimism there, and maybe that will be more contagious here going forward. All right, Rick Newman, great stuff. Thank you.
Bye, guys.
Have a good weekend. All right, keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, we're 45 minutes into the trading day. We've got a massive rally here on our hands. You've got the Dow up just around 560 points. You've got the S&P also trading up. It had been up just over 1%, now up about 0.9%. Also seeing some return here in the strength in larger cap tech names, with the Nasdaq also pushing to the upside today, recouping just a fraction of the losses that we saw earlier this week. We've got that and much more coming up right here on Yahoo Finance.
get to some trending tickers we're watching this morning. Shares of Bristol Myers up over 8% right now after the company beat on estimates on the top and bottom line for the second quarter. The drug maker also raising its full year guidance. So we're going to bring in our very own Anjali Kemlani with the latest. Anj, what do we need to know about Bristol this morning?
Yeah, Bristol having a pretty good quarter after it is starting to take a hard look at its books and has already signaled to the market earlier this year that it's looking to cut costs. It remains on course to do that, which would include laying off about 2,000 employees, cutting some programs, and consolidating some sites. But to the earnings, we've seen $2.07 in earnings per share versus the loss of 1.63 expected, and then revenue at 12.2 billion versus the expected of 11.55 billion. So that's a pretty good surprise there. And that's coming from sales of Eliquis, its blood thinner. We have to remember that Bristol is also one of those companies whose drug is under negotiations with the Medicare Inflation Reduction Act. So that is going to be interesting to see how that impacts next quarter, though we know that a lot of this has already been priced in. But the company doing pretty well for itself when it comes to the longer term outlook, also upgrading guidance to the upper end of single digits as opposed to the lower end earlier this year. So not a bad story for the company trying to get its ducks in a row, if you will, and definitely looking to the longer term, looking to maybe cut 1.5 billion and be able to reinvest that in its portfolio, in its pipeline, to make sure that even with the loss of exclusivity, even with the negotiations, it can continue to bring in stellar revenues.
All right, Anj, thanks so much for breaking that down for us. We want to continue the conversation surrounding some of the top trending tickers here on Yahoo Finance and take a look at Colgate. Shares in the green this morning. The company topping expectations, raising its full year guidance, accelerated volume growth, also higher prices, helping to boost sales in the most recent quarter. When you take a look at the street's reaction to this, they are very encouraged by the demand that we are seeing. Bernstein calling it, quote, remarkable set of earnings here from the company. Lots of questions about that volume growth, the pricing strategy moving forward. And Bernstein also pointing out that despite the huge step in advertising spend, gross margins are 80 basis points ahead of consensus. All of this to say that this staple stock, clearly when you take a look at maybe the 5-day move, but if you take a look at the longer term chart, either a 6-month chart or if you take a look at right around that year-to-date chart, we're still looking at gains of just about 24%. So again, people continue to spend or try to spend on those consumer staples products, and you have Colgate here at least now being a beneficiary of that.
Yeah, Colgate is interesting to look at, Shauna, because it is one of those names that indicates how consumers are holding up with their staples. If you saw a name like Colgate struggling, that would potentially be a really negative sign for the economy. If people aren't spending on those staples that are really a requirement for daily life, that could be a very negative indicator. So it's potentially good economic news to see a company like Colgate coming in well with their earnings print. I do also, though, just want to mention quickly that Colgate is another name that could potentially be impacted by the Federal Reserve's rate cutting cycle in a positive way moving forward, particularly if we do see declines in the dollar. This is one of those names that has a lot of international business, and if you start to have some weakness in the dollar, their businesses internationally could end up being a boon for them. That could also potentially be good for their dividends moving forward as well. So some good news if you are a Colgate shareholder this morning. Moving on, though, we're going to look at CrowdStrike. The CEO, George Kurtz, saying that 97% of Windows sensors are back online after a routine update from the cybersecurity firm, causing one of the largest IT outages in history. Yahoo Finance's Dan Howley has the details for us. Dan, definitely a tough week for CrowdStrike.
Yeah, absolutely, Maddie. A hugely tough week for them. Normally, they were known for being a very good cybersecurity firm with a very powerful marketing arm behind them. They managed to grow to enormous levels. And then obviously this update was a huge black eye for them. And they became kind of a household name for this problem. The grounding flights, hospital procedures canceled, businesses shut down, Some people saw the blue screen of death from Microsoft and thought it was a Microsoft problem. It wasn't. It was this CrowdStrike update. And so what they did was they released kind of an incident report on what exactly happened. And they said that it was an error in that software update that when certain computers were online, they got that update and immediately started to experience those issues en masse. Some Windows machines that were offline didn't have any issues. So if they just happened to not be turned on at that point, they were fine. So that's kind of why we saw some businesses impacted and some businesses not. And so they said that they're going to kind of reevaluate how they get their software updates out into the wild. They have a litany of things that they're going to be doing now to kind of double check updates to make sure that they don't cause these crashes in the future. Then, yes, as you said, they released the information saying that they have somewhere around, I believe it was 90-something percent, 97% of Windows machines are back online. But I think that the broader issue, some of the experts that I spoke to said this speaks to, is the lack of broad-based rules when it comes to these kinds of issues, whether that's software updates and how companies that are this large vet them, the different procedures that they put them through to ensure that they don't cause outages, and then what they can do afterwards, what customers can do and what the companies can do afterwards. There's no really kind of government regulation about how that works. And when you think about how these companies impact such a huge array of businesses, not just here in the U.S., but globally. They were shutting down news stations around the world. 911 service wasn't available in parts of Alaska. You figure that there has to be some kind of measure in place to ensure that these companies know exactly what to do if an incident like this occurs and how they can prevent them from occurring in the future. And unfortunately, at this point, it doesn't look like something like that is coming down the pike. And some of the folks that I spoke to essentially said, look, without something along those lines, this is going to happen again, whether we like it or not.
All right, Hallie, it's a story that we will continue to track just in terms of the fact that 3% still sounds like still not back online. So here we are a week out from this massive outage and still working to get back to 100% operating capacity. All right, Hallie, great stuff. Thank you. Keep right here on Yahoo Finance. We've got much more of your market action ahead. Let's take a look at the markets here, the broader averages, because again, we're looking at a massive rally here about an hour into the trading day. You've got all three of the major averages trading to the upside. You've got the Dow just off its highs of the session, but still up nearly 1.5%. You also got the S&P moving to the upside. Now, this optimism coming as the street grows even more optimistic that we will see a Fed rate cut this year. Now there's lots of talk about the fact that maybe the data points that we got out this morning support or further support the call for a rate cut in September. So again, we will see, but you have communication services, technology among the top performing sectors here this morning. We'll be right back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Today's PCE data mainly in line with expectations, though the Fed's preferred inflation gauge, so-called core PCE, rose, driven primarily by services spending. And this comes after the GDP data came in higher than anticipated. So how can investors weigh that mixed picture of the data, especially as we are ahead of the Federal Reserve's July decision coming up next week? Joining us to discuss, we've got Terry Wiseman. He's Macquarie Group's global FX and rate strategist. And we've also got Ryan Wayne. He is HSBC's U.S. economist. Thanks both for being here this morning. Ryan, I'm going to kick it off with you because I didn't even mention consumer sentiment data. So a lot of data coming in about this economy. What is the data point that you are looking at specifically to clarify the Federal Reserve's next moves?
Thanks a lot for having me. Well, I think what happened actually this week is that most of the most relevant information for Fed policy actually came yesterday with the second quarter GDP report. And in the end, what we saw was that growth in the second quarter and really for the first half of 2024 as a whole has come in a little bit more resilient than anticipated. Once again, repeating a pattern we've seen in recent years. Inflation, I would say overall, is conforming to expectations. Yes, today's number was a little bit more elevated than perhaps the Fed would like to see, but you're still looking at a year-over-year core PCE rate of 2.6%, and that is still a low for this cycle and significantly lower than 1 or 2 years ago.
Terry, what's your takeaway just in terms of what this means in terms of sentiment for the risk trade, how that ultimately impacts the FX market, and then ultimately, I guess, just determining the direction that we could see just given some of this uncertainty and back and forth?
Yeah, so look, I think one of the most unusual things about what markets have to deal with now is that the Fed does look like it's getting closer to a rate cut, most likely at the September meeting, certainly unlikely to be delivered at next week's meeting. And I think for a lot of financial market participants, the idea of Fed rate cuts is sort of inherently associated with weak economic growth, maybe even recession fears. I guess what's different this time around is that's really not the backdrop that we have. Instead, what we have is inflation that was very high 2 years ago. It's come down considerably, but you have an economy that continues to outperform. So I think markets are having a hard time trying to deal with what this actually means for the outlook over the year ahead.
Terry, what do you think? Do you agree?
Well, look, if you're asking about how risk takers are approaching things right now, I think the sentiment here has been dominated in the last few days, not by necessarily what the Fed is going to do, although that is important, but really what's been happening with corporate earnings guidance, which has not been very good in the United States or in Europe. And I think if it were not for the prospect that the Fed is going to start easing, presumably in September, you would have seen a lot more risk-off sentiment prevail in the marketplace in the last few days. I think one of the things that is holding up sentiment, despite the fact that we have signs of a slowdown in the May and June data cycle in the U.S. and with respect to the corporate earnings cycle, is the fact that the Fed is going to be cutting this year, as are other central banks around the world.
Terry, I want to stick with you for a second because I read in your note that you sent over to us this morning that you mentioned the picture that we're getting that's kind of mixed given some of the earnings data alongside the macroeconomic data. What is the bigger driving factor for you? And do you think that, I guess I should say, do you think the Federal Reserve might be missing something here if they don't look at the earnings data that we're getting in, which does appear to be kind of mixed so far?
If it was only the earnings data that was looking a little poorer recently, then it's very possible the Fed, as macro watchers, could have been missing something. But it's not just the corporate earnings data that's been coming in softer. Certainly, we've had the labor market data in the U.S. come in softer as well. So, for example, initial claims 20% higher at this point than they were at their trough. Continuing claims 30% higher than they were at their trough. These are signs that the labor market is slowing down, and given that maintaining full employment is an important mandate of the Fed, I think that they would have been watching that certainly. And by the way, if it were only 2 months of low inflation that we had seen, I would not be, nor would my colleagues be, calling for the Fed to be cutting as early as September. It's not just that inflation has come down from where it was in the first quarter and the early part of the second quarter. It's also that we've gotten some weakening, some loosening, if you will, in the labor market. That is the thing that has accelerated the prospect that the Fed will be cutting rates.
Ryan, we have seen some weakening, some loosening, some softening, like Terry just mentioned there, within the labor market. But balancing this risk, though, of moving too quickly, how real is that risk still? Is that risk still on the table if the Fed were to move in September, that it would be jumping the gun just a little bit?
Well, yeah, I think there has been signals in the labor market that certainly compared to 2 years ago, there's less labor market imbalance. There's not such a big disparity between labor demand and labor supply. And perhaps the clearest sign of this has been the gradual drift higher in the unemployment rate, up to 4.1% in the June data. And that's up from a low of 3.4% a little over a year ago. That is very interesting. And historically speaking, it's also quite rare to see a drift higher in the unemployment rate. Typically, it's either not rising at all or it's spiking higher and really giving rise to recession concerns. So I think that's relevant. I think it does show that the kind of the incremental change in the labor market might be shifting. But I think for Fed policymakers, they're still not considering the current economy a scenario where the labor market is necessarily deteriorating more rapidly than they expected. And so what that means is that the Fed may deliver some rate cuts, but I don't think at this stage the Fed is prepared to move aggressively because the labor market overall is still evolving in a kind of incremental fashion.
So Terry, then to put a button on this, I mean, is this, it sounds a lot like Goldilocks to me. I was going to ask you, is a rate cut in September potentially about preventing weakness, a reaction to weakness from the Fed, or is it just the best case scenario, a Goldilocks move?
It could be both or all three. The Fed has to be, to some extent, anticipatory. If it weren't, they really couldn't call themselves economists. I mean, one of the jobs that policy economists do is try to look at the data, but also try to extrapolate from the data what is going to happen so that they stay, effectively in front of the hockey puck. I think what we're seeing now is a trend towards weakening. It's not an aggressive trend. I think what we've done is we've moved from above trend growth in the US to trend growth. That's really the major shift that we've seen in the last few months. It should not be terrifying to the Fed, but if they're anticipating what will happen in the event that they do not cut, I think what they would see is further slowing to below that trend, and that's why they're going to try to preempt that with a cut. Let's be very clear here. Every recession that has taken place in the US usually starts with growth above trend. It then moves to a level that's a little bit more on trend and Goldilocks before it finally breaks below trend if the Fed is too late, if the Fed makes a policy error by not cutting aggressively enough. We saw that in 2006 and 2007. The Fed kept rates high for long, for about a year, which is exactly how long they've kept it high this time. But then when they started to cut, in some way, it was too late. You had a recession by the end of 2007. They certainly wouldn't want to repeat that.
All right, Terry Wiseman, Macquarie Group's global FX and rate strategist, and our thanks to Ryan Wong, HSBC's U.S. economist. Thanks to you both for hopping on with us here for today's panel.
Thank you.
All right, keep right here on Yahoo Finance. We got much more of your market action ahead. You're watching Catalyst.
A jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Capital Gains, Yahoo Finance's unique look at how U.S. government policy will impact your bottom line long after the presidential polls have closed.
Our bottom line, it's still the economy, people.
We've got team coverage from New York to Los Angeles, but we start right here in Washington, D.C.
You can catch Capital Gains on all your favorite podcast and streaming platforms. You can't afford to miss it.
JP Morgan reportedly launching a generative AI tool. That's according to the latest report out from the Financial Times. The bank will give several employees in its asset and wealth management division access to a tool called LLM Suite, its own version of ChatGPT. When you take a look at what this is expected to do, it's going to be able to idea generation, summarizing documents. It's going to help with writing. This is all according to the report. They said in an internal memo here. JP Morgan started introducing this LLM Suite to pockets of the bank earlier this year, and about 50,000 employees now have access to it. And Maddie, it's also important to point out that we have seen more and more, especially within the financial industry, really start to integrate some of those AI capabilities within their day-to-day operations. Our rival, Morgan Stanley, partnered with OpenAI and rolled out a Gen AI-powered chatbot last September. And I think the question that so many people probably within these banks are asking as to what exactly this means for some of those more entry-level roles, and whether or not this could potentially replace the need for the extensive analysts that are hired every class out of college.
Yeah, no, it's 100% true, because that is mainly the role of those kind of lower level, entry level, I should say, figures to kind of look at the data and the numbers that higher level folks are crunching and turn that into some, deck or memo or analyst notes at least. It's interesting, they're calling it the LLM Suite. This is, of course, their own AI platform, but you had mentioned earlier, Shauna, that JP Morgan had historically been a little bit skeptical of external AI systems, and that's likely due to the compliance and security issues related to those systems. Our very own Jared Wickery noted earlier today that what's going to be unique about this is that all of the interactions with the AI are going to be logged, so that could be helpful moving forward if there are any compliance concerns. All of this is going to be kind of monitored by the company, which is not really a surprise, but something for employees to definitely keep in mind if you are utilizing it. I just think it's a huge deal for the industry that has so many issues with something like work-life balance, for example, right? This gives them the opportunity to focus on crunching the numbers, and then maybe you put those numbers into the LLM Suite and it turns it into a research report for you, so that you don't have to spend your time turning those numbers into a broader story, at least to such a degree.
Yeah, exactly. And then I also think, going back to the employment side of things too, I think there's so many questions about what ultimately this is going to do when we talk about the adoption of AI and what that's going to do to boost productivity. There's also a lot to talk about what it's going to do to potentially replace jobs. And when we've seen various estimates come out of some of these larger Wall Street banks, but Citigroup estimating that the technology could actually add us $170 billion to the banking industry by 2028. They also, though, warn that it could displace more jobs in this sector than any other, 54% of roles having the high potential to be automated. So you talk about the lasting impacts, but then I think you also need to couch that with the fact that As you have seen in past technological advances, a lot of times that's an opportunity to create new roles or help some of the current roles evolve a little bit. So that's also been playing out in those discussions as well.
Yeah, maybe more ideas for trades instead of just having to write about them. And to your point too, definitely not just JP Morgan, Citibank, Deutsche Bank, and others experimenting with AI as well. All right, we're going to have all of your markets action ahead right here on Yahoo Finance. If we take a look at the boards here, you're still looking at gains across your screen, looking at the S&P up nearly 0.9%, the Nasdaq pairing some of its earlier gains up now just about 0.6%. You're watching Catalysts.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4th, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
Let's take a look at the market here with stocks moving to the upside, though we are paring back some of the initial broad gains, but still, of course, seeing a lot of upside movement compared with the rest of the week here. The S&P up just about 0.8% and the Nasdaq up nearly 0.5% here. Now, this comes as we have data pointing to slowing inflation and surprisingly strong economic growth, fueling expectations of a September rate cut. So joining us now to discuss, we've got Nancy Dowd, Ameriprise Financial Private Wealth Advisor. Nancy, thanks for coming on. I love that top. Thanks for joining us. So I want to start on what we are seeing specifically in some of the big tech names here. You mentioned in your note that the market is undergoing a minor repricing. What do you think that means in the short term for some of the major tech names that have really driven the market rally so far?
Well, I think we've seen it. You know, in the short term, we've had a big dip in the big tech. And it was a little unnerving that the entire market in the first half of the year was led by a handful of stocks. So the good news is today, I think the rebound is likely due to the broadening of the market a little bit beyond tech and some small cap as well. So that's exciting. We always get very nervous when there's only a handful of stocks dominating everything. So this looks better.
So Nancy, this is reassuring, and I think a lot of people on the street would maybe agree with you that obviously we were due for some sort of rotation. We were due for some sort of broadening given the massive outperformance of those tech names. But let's just stick with tech for a bit. Do you expect more pressure on those handful of names, on the Mag 7 names, just given what we saw over the last couple of trading days following the earnings results from Alphabet and from Tesla, and whether or not maybe that signals tougher times ahead when you take into account that the earnings bar has been set so high?
Yes, I think it's likely to take a little bit more of a beating, which wouldn't be unusual because these valuations have been somewhat dreamy, I would think, right? I think that there's probably going to be a great deal of volatility in that sector. However, having said that, I'm still very, very bullish on tech, and it is absolutely where it's at for the longer term, given all of the innovation and the AI boom that's occurring right now.
Well, Nancy, this was going to be my question to you from a personal finance perspective, and I'm talking like very personal here because I am curious for those investors listening who maybe have a lot of their portfolios in ETFs that track the S&P, the Nasdaq, and then you see a week like the one that we've just had where there is a lot of pressure coming to the surface in some of these big tech names. Is that an indication that if you've missed the tech rally so far, it's time to be getting in? Or is it an indication of a rotation to come where it's better to kind of avoid getting too hit by that by maintaining your investments in some of those broader baskets of ETFs?
So I think when you're thinking about your own personal finance, it's very important to really take a deep breath and sit back and evaluate, where am I today? Where do I want to be? And how long am I in it for? And of course, a very important part of this is what's my stomach lining or appetite for risk? Because if you're really going to be in ETFs mirroring the S&P and technology, you're going to be on a roller coaster ride for the most part. Yes, ultimately you might do well, but can you handle the interim volatility? So I think when it comes to personal finance, it's really different for each person. You know, it's not a one size fits all thing, but the broader market is coming back with a vengeance, we hope. And I think it's time to deploy the cash and look ahead for the longer term.
Nancy, what's going to be the catalyst for that next leg higher?
I mean, it's hard to say. There's been so much drama around the U.S. elections. There's certainly a few wild weeks here that has averted investors' attention. So almost anything could happen. We're also in the summer months here where between July 4th and September, the joke around our office is Wall Street takes holiday and goes to the Hamptons. So everything just is up and down. And in the end, you're at the same place in September. Inflation is cooling, both U.S. and Europe. And so that's some good news. Earnings look strong. The consumer confidence is fairly strong. There's still a lot more spending than money coming in, unfortunately. So that's a concern. But I think that it's really more of the same.
Nancy, I want to end by asking you specifically about some of the sectors that you gave us some notes on. And I want to zero in on financials because you talk about how these are the companies that are benefiting from higher interest rates. But then also, obviously we have the Fed expected to cut rates moving forward. And then we also have some of the challenges that are really impacting the financials space, of course, CRE being among them. Why do you think that financials are still potentially an area for investors to be looking at?
Well, it's always a solid sector, financials and energy and healthcare. Those are all sectors that are solid, mainly because they tend to remain stable, even with ups and downs in the markets. They may have some volatility at times, but I think these are good sectors to be in. Many of them are dividend paying, so that offsets some of that volatility. As far as rate cuts, we have yet to see that happen. I mean, everybody's banking on September rate cuts, but that's not 100% sure yet. We're still a month or so away from September, and anything can happen in between. So we have yet to see. We just have to keep monitoring. But the opportunities are clearly, if we are expecting rate cuts, then it would be in fixed income and small cap stocks.
All right, Nancy Dowd, Ameriprise, a financial private wealth advisor. Thanks so much for hopping on with us here this morning. Let's do a check of the markets. We're 90 minutes into the trading day. And again, we're looking at gains across the board. You've got investors buying ahead of the weekend, coming off of what has been a tough couple of days here for stocks, led by that rotation out of larger cap tech names into underperforming areas of the market. Now you've got the Dow actually back up about 1.5%. You've got a bit of a rebound going on inside the Nasdaq. You got the Nasdaq Composite up about 0.5%, and the S&P also pointing to the upside off the highs of the session, but still well in the green, up just about 0.8%. When you take a look at the sector action, where we are seeing some of that strength, a lot of that coming from technology, from communication services. That's also an outperformer here, as well as financials. Underperformer in today's market action, at least so far, is energy. It's the only sector trading to the downside, off just about 0.4%.
Yeah, and we're seeing some of those big tech names doing well too, Shauna. So we're going to switch gears a little bit, though, because I'm going to be with you for Wealth coming up next. It's dedicated to all of your personal finance needs, so stay here for more and have a great weekend. Welcome to Wealth. I'm Madison Mills in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to know to grow your money. On today's show, we've got new inflation data showing price growth continuing to slow. I'll break down the good and bad news and what it could mean for your portfolio. We'll also talk about which cities could be the best to rent in. We're going to give you the top 2 cities to get the biggest square footage for your money. Plus, is it too late to invest in gold, or will it just keep climbing higher? I'll talk to an expert about the best ways to invest in the precious metal. First up, I want to give you 3 key things that you need to know from this morning's PCE, or Personal Consumption Expenditures Index report. This is a key measure of economic growth. First, I'm going to start off with housing. It's driving a lot of the price increases that we are seeing. In a post on X, former director of the National Economic Council, Jason Furman, shared a chart showing that without housing, core PCE only rose by 2%. Remember, 2 is the number the Fed wants. And on a 3-month average, it was around 1.8%. Second here, the savings rate. This is important for those of us who are looking at our savings. It went to its lowest level since December of 2022. It's now at 3.4% versus the 3.9% we saw a month ago, a bigger drop there. That means the amount of personal savings Americans are stocking away as a percentage of disposable income is starting to slip. Could be a bad sign for the economy. But finally, we've got personal income. That was good news. It increased, but at a slower pace than the month prior, up just 0.2%. So with lower savings, slowing personal income growth, these are key things to watch as we hear about a consumer pullback, especially on these earnings calls that we've got throughout this earnings cycle to come. Now, the latest inflation data supporting the narrative that inflation is easing in the economy could achieve a soft landing. But how does today's print impact the Fed's meeting next week? Yahoo Finance's Jennifer Schomburger is here with the details. Jennifer, I was just mentioning a lot of mixed data in this print. What do people listening need to know about what it means for them?
Hey, Maddie. Good morning. Yeah, the print came in 0.1% above expectations. But if you look under the hood, as you just went through a lot of stats right there, it looks pretty good for the Fed, especially if you look at it on a 3-month annualized basis. I have in my notes that PCE for the past 3 months now dropping to 2.3% from 2.9%. And the Fed is looking at some shorter term metrics when it comes to inflation, not just that year over year number. So this is encouraging. It's moving in the right direction. And many folks I'm talking to this morning say this solidifies the potential for a September rate cut, which means come next week at the policy meeting for the Fed, for the July meeting, they will likely set the stage for a rate cut in September. Now, of course, they can't commit wholeheartedly because we still are going to get some more data for July and August, but it seems to be moving in the right direction. This is good news for investors.
Jennifer, I want to follow on the consumer sentiment data that we got in here, falling to an 8-month low because of some of the high prices that we're getting in. And it's fascinating given that yesterday we had GDP coming in at 2.8%, but then people just aren't feeling that growth in the economy. What are the conversations that you have with sources that you can pull to explain to us where the disconnect is in the data and how people are feeling?
Yeah, so it's going to be choppy, right, Madison? Like, it's not going to be a straight line. And, you know, if you look at GDP, it was stronger than expected, which gives you sort of more a Goldilocks scenario, I think, for the Fed. Yes, people are feeling inflation, but wages are also growing at a faster rate than inflation. So they're going to grow, but they're still going to be able to pay the piper, right? The question is what happens in the second half of the year for growth, but certainly growth was strong in the second quarter, and that's going to give the Fed hope for this soft landing scenario.
All right, Jennifer, we'll have to leave it there, but thank you so much for joining us to break all of that down. As always, we appreciate it. Well, we recently got an email in from a seemingly fed-up viewer asking why we cover Elon Musk so much. We do read our audience feedback, and it is true. We cover Elon Musk a lot. We've got a story about him basically every day, or at least a Musk-adjacent story. But he also comes up in the news a lot. So while it can be controversial, but it is important to cover as it kind of relates to Tesla and the broader business picture. So joining us to discuss the dichotomy here, we've got Yahoo Finance's very own Julie Hyman. Julie, I'm so excited to get your take on this.
Well, it's so interesting, right? This, by the way, this email came into our Rick Newman from a faithful Yahoo Finance user. And Rick is very good at engaging with our reader email. And so he passed it around. And, you know, I said, okay, let's look at this issue. Let's actually kind of dig into it. And I wrote about it in the takeaway in this morning's morning brief. So, you know, there are a lot of legitimate reasons to talk about Elon Musk, right? If you look at Tesla, of course, that is the dominant EV maker in the United States. You can also sort of look at it as a proxy for the bigger EV industry. They have the energy storage business, which has been growing as well. And that could be sort of the next phase of what we'll see, not just from Tesla, but from other companies in the industry. The self-driving technology, they've been a pioneer, again, at least in the US, as they try to push that forward. And whatever they're doing with AI, we don't know exactly what Tesla is doing. We know he's doing stuff with it with his other endeavors. So these are all, you know, they're part of the bigger conversation right now. There's also just the sheer size of the companies that Musk controls that make it sort of imperative for us to talk about. I mean, Tesla itself, about $700 billion in market cap, and it is widely held. SpaceX, $210 billion reportedly, $12.5 billion for X, the artist formerly known as Twitter, The Boring Company, around $7 billion, and then XAI, which is his separate AI endeavor, about $24 billion. So that's, you know, listen, when you talk about any single company or even one collection of companies in the greater slice of GDP, it's not huge, but you know, he has a big impact in a lot of different industries. And then we have ways of measuring how interested our users are. And people are very, very interested in Tesla. I got our Jared Blickery to crunch the numbers on our trending tickers page, which is a page that you and I look at a lot. Everybody here really looks at a lot because it tells us what our users are looking at. Year to date, NVIDIA number 1. Tesla number 2, though. And then followed by Apple, GameStop, and Bitcoin. So Tesla is of enormous interest. So, you know, this is why we talk about them a lot.
I love that you are doing this segment and that you got that data from Jared, because it is so interesting. If our job is to like be a conduit for the audience and cover what they want, it seems like they want Tesla, but also are we kind of feeding the beast?
Well, you know, it's always a balance with these kinds of situations. We don't write up or talk about every tweet. Right? Or every post on X, as we now have to call it. We don't, right? We don't talk, but we do talk about Tesla very frequently. For example, today the stock is down, and it's down because it got a downgrade. Jonathan Wu over at Phillips Securities cut it to sell from reduce, which is an interesting difference. The price target there is 135, and he highlights that near-term margins could be under pressure because of pricing and because of EU tariffs on China exports. So again, there is a fundamental reason to talk about Tesla, the stock, and you know, more than as you know, when we talk about companies, the CEO is not always part of the same breath when talking about the companies. But in the case of Tesla, in the case of X, it is.
Absolutely.
Because there's no more key man risk than Elon Musk. And you know what I mean? He is really bound up with the companies in a way that not many other CEOs are.
I've also been thinking a lot lately about how there's Tesla the stock and Tesla the company, and how I should be differentiating the moves between the two, and whether or not the stock is moving because of a company thing or because of a technicals thing or because of something Elon Musk said.
Right.
I'm thinking about that
tricky
difference.
Thing to figure out. But that's not, that part at least is not unique to Tesla.
Right. That is very true. That is true. Well, Julie, thank you so much. This is really fun. Thank you for bringing us that story. Appreciate it. Coming up here, what you need to know about buying a home or renting one. We're going to break down what you need to know about both options right after the break, so stick with us. Let's talk about the housing market because mortgage rates rose slightly from last week, continuing to pressure potential home buyers. The average rate on the 30-year fixed rate mortgage rose 6.78%. That's just a basis point from the prior week. The moves are still weighing on buyer appetite, and potential buyers are waiting to see some relief. So for more on this, I am joined by Orphy Devungi. He is a senior economist at Zillow Home Loans. Orphy, it's great to have you on to discuss this. Thanks for being here. So I want to talk about how the Federal Reserve's potential and highly anticipated September rate cut could be impacting home buyers right now. If you are currently out there looking to buy a home, should you just wait until October?
Well, first, thanks for having me. I think people are very excited about the prospect of the Fed cutting interest rates, but I don't think that lower rates will translate into lower mortgage rates immediately, as some expect. I think mortgage rates are likely already reflecting Fed expectations. And if the Fed delivers fewer rate cuts or none at all, we're likely going to see some upward pressure, not downward pressure on rates. You take that and you add growing fiscal deficits. The fact that the government needs to borrow to fund its operation means that the pressure isn't likely to abate anytime soon. We just got this Q2 GDP numbers that shows the economy is pretty strong. That will likely put upward pressure on yields. So you have all those factors, and I just don't think the relief is going to come from rates necessarily. I think that the encouraging signs for potential home buyers is the fact that the housing market is rebalancing, that a quarter of sellers are cutting their prices, that inventory is 23% higher than it was a year ago. And so those are factors that could help as price growth continues to ease.
So when is the best time to buy then if you are a potential homeowner?
Well, look, right now we're seeing home sales have fallen by 5% in the last month. Existing home sales fell by 5% in the past month. But with mortgage rates kind of where they're at and the labor market remaining somewhat on solid ground, right? You're looking at potentially buyers turning to new construction. New home sales were essentially flat. They fell by 0.6% last month. And my feeling is that as we see more and more new homes coming on the market, and buyers might turn to new homes, you also have the fact that 61% of builders are actually offering incentives to potential home buyers. We're talking about rate buy downs, but also some price cuts. And so you combine those factors, and it's likely that new home sales could potentially start increasing again.
One other thing I want to ask you about is this research from Zillow about the number of $1 million starter homes. I want to get that number from you, but it freaked me out. This idea that starter homes you're looking at $1 million. That's not good news for someone who has yet to buy a home.
Yes, there are many cities where it's now going to take you you're going to need a lot more in order to step on the first rung of the housing ladder. Those cities are concentrated in those expensive coastal markets. Basically markets, people want to live in California. They want to live close to the sea. They want to live near these productive job centers. But unfortunately, supply of housing lags in those markets. And what we learned essentially is that the markets with the most restrictive building regulations are markets where a starter home now costs $1 million or more. And those are also markets where home ownership rates are some of the lowest in the country.
I want to end on the refinancing question for those who are looking at interest rates right now and thinking, well, I can just buy and then refinance later on. Talk to me about your advice for those folks.
Look, homeowners are sitting on near record home equity, and the real value of their mortgage interest payments has actually declined during the pandemic. And so renters, right, potential first-time home buyers are the ones that have really felt kind of the pain, right? For the last 3 years or so, we saw wages increase much slower than rents. Rents are now 33% higher than they were before the pandemic. And so during that time, we saw the value, the wealth of homeowners really increase much faster than that of renters. And so the benefits of buying are still there for most people. And so, my advice to potential home buyers is to start early on your journey to home ownership. And that really means getting pre-qualified first, right? Zillow came out with a great tool called Buyability. And what Buyability does is it allows potential home buyers to type in their credit score, and it actually shows them the likelihood that they can afford the home they're actually looking at, right? It actually changes and fluctuates as mortgage rates change. We've seen large fluctuations. And so it's really important to be able to get the accurate information right away in order to make the decision to jump into the market. And I think once you've pre-qualified yourself, essentially, the next step is to talk to a loan officer. A Zillow Home Loans loan officer can actually be helpful, potentially highlighting areas where you can improve your credit score and how to get the lowest possible mortgage rate. Really, the focus should be on getting more people home, and Zillow's trying to do that.
All right, Orphe, we got to leave it there. Really appreciate your insights and time. Thank you so much. That was Orphe Divounguy. He's a senior economist at Zillow Home Loans. Now, housing-related inflation remaining one of the biggest contributors to services inflation in today's PCE report, rising 0.3%. And we know renting can be expensive, so here to discuss where you can get the most bang for your buck across the U.S., we've got Doug Ressler, Rent Cafe senior analyst. Doug, it's great to speak with you here. So talk to me about some of the best cities that you've found where you can get rent as low as $1,500 a month, which, not to show my bias here, but that does sound very low coming from someone who rents in New York City.
Thanks. Thanks for having me. $1,500 a month was chosen out of a nationwide average for apartments. So yes, you're right. What we found is we were doing a comparison. Rent Cafe did the article, Yardi Matrix Data. We're part of Yardi Systems. And basically what we found is that on the average, renters can expect, again, this is a national number, about 729 square feet nationwide for that amount of money. Where do you get the biggest square footage? Wichita, Kansas, Toledo, Ohio, Oklahoma City, Midwest. Why is that? Because the Midwest has gone for many years because of undersupply. It's getting new supply now. There are tech hubs. There are foreign companies that are relocating there. Reshoring is going on. The availability of land is a little bit freer in terms of density, like you have with gateway cities. And so what you're seeing is that price relates in terms of what developers can do for amenity-rich type of development with larger apartments. In addition, we also see that millennials are renting longer, which means that they are starting families and need more square footage. And so with that square footage, like for example, Wichita, Kansas, 1,359 square feet. The starter home, average starter home nationwide is about 1,400 square feet. So it pretty much approximates it.
Yeah, it's a really good point, Doug. The issue, and I'll personalize this, I can't, be an anchor on a finance program in Wichita, Kansas. Unfortunately, so many of the jobs that myself and my friends and colleagues want to pursue careers in are based in some of those big coastal cities that are so expensive. What is your advice to those folks whose career ambitions and personal finance ambitions, as it relates to their housing, don't always coincide?
Well, like your previous guest, do your research. Rent Cafe, Yardi both have platforms that people can use to be able to assess their needs and where they want to live. It's more than just about the house that you want or the price you want to pay. It's also the social environment that goes on, the type of things that people want to do in terms of urban planning and lifestyle preferences. So do your research and look at it longer term. It's not just over the course of 12 months, but it would be longer term in terms of the next 2 years, what you see. If you're getting an education, if you're going to be employed in the same general area, what does that mean? Obviously, the suburbs versus urban density also give space allowances for that, especially in gateway cities like Philly and New York City.
What is it looking like for some of those gateway cities? Are we seeing any price declines in some of those mid-tier cities for folks, or is it still going up?
We have been seeing deceleration in rent, reason being it's economics 101. There's an unprecedented amount of new supply coming on board. almost 500,000 units this year and almost 500,000 units next year. That is going into a lot of the gateway cities. And so with that, the consumer has more options to choose from. And with that, it drives prices down.
All right, Doug, we're going to have to leave it there. Thanks for joining us this morning over the phone. Hopefully we can get you on camera next time. That was Doug Ressler. He's Rent Cafe's senior analyst. Coming up here, big changes coming to how you can access Social Security online. We're going to have more on what you need to know on that after the break. Big news for those anticipating an inheritance because the IRS has issued final regulations on the required minimum distributions for inherited IRAs. Here to weigh in on what this means in the context, we've got Jeffrey Levine, Buckingham Wealth Partners Chief Planning Officer. Jeffrey, it's great to have you on here. So take a huge step back for me because I'll be honest, I was not familiar with this story before hearing about it today because I'm not someone who's really anticipating an inheritance. But talk to me about what this means and why it's important.
Yeah, so the big news out of this is that a number of years ago, Congress passed what's known as the Secure Act, and that changed the game for most non-spouse beneficiaries, someone other than your husband and your wife who's inheriting your retirement account. Previously, individuals were able to what is called stretch distributions over the course of their lifetime, which meant if you were a 40 or a 50-year-old, let's say, child of someone inheriting an IRA, you might have 30, 40, or even 50 or more years over which to spread the income from that account out. But the Secure Act a number of years ago made that just 10 years for most individuals. And when the law was first passed, That's sort of what everyone thought it was. It was just get everything out by the end of 10 years. Well, the final regulations that were issued just last week by the IRS say that some individuals, depending upon a variety of circumstances, not only have to comply with that 10-year rule, meaning everything out by the end of the 10th year after they inherit, but they must also take minimum distributions in each of those 9 years before the 10th year, which is just very complicating.
Yeah, so talk to me about that. What should both, I guess, parents and their children be doing to prepare for kind of the logistics of that situation?
Yeah, so I think the biggest thing here to remember for individuals is that when you're doing tax planning, the goal is to minimize taxes over a lifetime. And in the case of individuals where they're leaving beyond assets beyond their life, let's say to a child, a grandchild, or some other loved one, sometimes it's not about even creating the lowest lifetime tax bill. It's about creating the lowest multi-generational tax bill. So if you're someone who's been fortunate enough to save a good deal during your life, you have a good sense that you may not need all of those dollars during your lifetime. One of the things you can consider is, hey, is my tax rate in retirement lower than, say, my children's tax rate when I leave this to them? If it is, you might think about doing something called a Roth conversion, moving that money from a taxable account into a tax-free account. It'll cost you money, but it might save your kids even more down the line. So it's really about working together as a family to minimize the cumulative income tax impact of these distributions.
And Jeffrey, I want to get your take too on those who want to be able to set themselves up to be able to pass on some inheritance to their children or their further individuals in their lives. Sure. What should they be doing to prepare their accounts to be able to pass that on to folks?
Well, the number one thing is to make sure you name those individuals on the beneficiary form. Retirement accounts are different than other accounts. You may be familiar with that old expression where there's a will, there's a way. Well, whoever wrote that wasn't someone who dealt with retirement accounts very much, because where there's a will, there's no way it's going to work out very well. It needs to be on a beneficiary form. Each of those IRA accounts and 401k accounts and 403b accounts and all those similar retirement accounts that an individual might have should have a beneficiary form associated with that, where you list the individuals who you want to inherit your dollars. And you should not only keep track of that yourself, but you should review that on a regular basis, either on your own or with the help of your financial advisor or tax professional. But it's critical to make sure these forms stay up to date, because that's what's going to generally dictate where those dollars go. It overrides your will.
Really important point there, Jeffrey. Thank you so much for joining us, and great job explaining what can be a little bit of a complex topic. We really appreciate it. That was Jeffrey Levine, Buckingham Wealth Partners Chief Planning Officer. Sticking with retirement, if you plan to claim Social Security, you're going to want to listen in to this. Changes are coming to the Social Security website that could impact millions of beneficiaries. Yahoo Finance's very own Carrie Hannon is here to break it down. Carrie, great to speak with you again today. So talk to me about these changes. What exactly are they and who could it impact?
Hi, good morning, Madison. So good to see you. This is a big deal in many ways because millions of people are going to be impacted, and it's about the Social Security website. What this means is how you access your retirement in your Social Security account, what the benefits are, and everyone needs to have access to it. And what it is it's switching you over. You go to the Social Security website, ssa.gov, and they want to shift you over to create a login.gov account. This is a shift in how you're going to access this information. And what you set up is, they call it, and it's a wonderful account, is My Social Security account. This account is personalized for you. It tells you, what your benefits are. If you're already getting Social Security, it tells you, you can monitor your account there. It tells you all the different elements of it that helps you make this decision about when to take Social Security. So the change is, if you've opened an account before September 18th, 2021 is kind of the key date, you need to go back in and redo your account. If you've never opened one of these accounts, this is the time to do it. And Madison, what I really love about these My Social Security accounts and having this online access is it gives people information they need to decide when to start taking Social Security. It clearly lays out a chart for you that's personalized to your information of when you're going to get the most benefit. And what happens is most people start their benefits at 62. I shouldn't say most, about 40% of people do. And that is the earliest time you can start drawing down your benefit from Social Security. But if you can wait till your full retirement age, which right now is roughly, 67 if you were born in, say, 1960, and you're full up till age 70, you can get it keeps increasing 8% a year from your full retirement age till age 70. And it's really can come to, as much as over $1,000 a month. This is not chump change. So I think it's really important that people monitor these, have access to their own numbers, and it really helps you get a feel for what this means to you. So I encourage people, but this change is coming, and Social Security is pushing the word out there to get people to change over to this new web portal.
Carrie, I literally just wrote down 2K at 67 so that I can cite that later in my conversations with my family. But I want to ask a quick follow on Social Security. At what age should you be setting up that Social Security account?
Well, you should actually get your Social Security account going as soon as possible. I mean, I think right now it's a good time for people to start monitoring this account. And I think the other thing that's important with retirement this year, Madison, to think about is this is in this whole realm of retirement. I get all excited talking about it, but Medicare is a big deal this year, and it is every year. But if you're turning 65, which more Americans are turning 65 this year than ever in history, you need to pay attention. You need to sign up for a Medicare account. Either you can do it 3 months before you turn 65, the month you turn 65, 3 months after. But if you miss that sign up window, you can be hit with penalties that impact you for the rest of your life. I mean, this is significant, these penalties for late access, late enrollment, and Medicare. Now, there are exceptions. If you are currently employed, a lot of people are working past 65. So if you're currently employed and an active employee and covered by an employer plan, you don't have to worry about this right now. You'll need to show proof that you were getting insurance during this time through your employer, or if you're covered by your spouse's employer as well. But it's super complicated and confusing, and I think everyone needs to sort of pay attention. There are other caveats along the way, but the most important thing is sign up for Medicare at 65 for most people. And secondly, you're going to need to make that decision. Do you want Medicare, traditional Medicare, or Medicare Advantage? And more than 50% of Americans are heading into the Medicare Advantage plans. There's big differences between these plans, so you need to do your homework. This is super important, and it really hits your pocketbook for sure.
And just, I mean, as always, Carrie, you bring us such great information. A lot of us, I think, are going to move to set up our Social Security accounts after this segment today. So thank you so much for taking the time and for explaining the Medicare piece as well. We appreciate you. Have a great weekend, Carrie. Thanks so much.
Thanks, Madison.
Well, coming up, the 2024 Bitcoin conference is happening now in Nashville. We're going to have the details on that and what you can expect it to mean for cryptocurrencies when we come back. Let's talk about crypto because the Bitcoin 2024 conference is underway in Nashville. Former President Trump expected to speak there on Saturday. And we have live coverage on the ground with Yahoo Finance's David Hollerith. David, so excited that you are there covering this event for us and that you could join our show. Just talk to me about what you're anticipating, what you're hearing from people on the ground.
Hey, Madison. Yeah, so we're in Nashville, Tennessee, and it's a mix of crypto, and I think there's a little bit more of a political focus too. Typically, when Donald Trump speaks this campaign round, there is a group of people that will follow him for rallies. So we might see that tomorrow. Today's big ticket item is from the independent presidential candidate, RFK Jr. RFK Jr. is actually a returning speaker to the Bitcoin conference. His libertarian stance obviously fits well with this crowd. I don't know if you can hear it behind me, but there's bluegrass playing and there's a lot going on inside the venue. There's a Bitcoin NASCAR car that's on display. So there's tons of buzz happening right now. As far as what we can expect from RFK later today, he speaks at 4. We're thinking this is going to be more of a anti-censorship, privacy-focused conversation to the Bitcoin and larger crypto community. That's as much as we've gathered at this point. There are also some other speakers beforehand. Edward Snowden, the NSA contractor turned whistleblower, is speaking about 30 minutes before him. So we're definitely going to be interested to see. But RFK has stepped on sort of being a crypto proponent even before Trump, which is worth pointing out. As recently as last night, he said he's a huge supporter of Bitcoin, sort of doubling down on that. He also said he holds most of his wealth in digital assets. So he's clearly a fan, someone that the crypto community has a lot of support for already.
Fascinating investment decision to have all of your wealth in crypto, David. We're going to have to unpack that choice on our wealth show later. Thank you so much for making the time, David. And you can follow David Holler's coverage at the Bitcoin 2024 conference in Nashville on the Yahoo Finance platform throughout the weekend. So with all of the hype around that conference and the recent debut of spot Ethereum ETFs, a lot of crypto talk, you might be feeling a little bit of FOMO when it comes to breaking into crypto investing. So here on set with us to explain the basics, we've got our very own Yahoo Finance contributor, Ross Mack. Ross, it's great to have you in studio with us.
Always.
Talk to me about the basics here. If you are one of those people who hears that RFK Jr. is investing all of his wealth into Bitcoin and you're thinking that's crazy, should you be thinking about getting in instead?
Well, one, I'm not going to tell anybody put all their wealth in any particular asset, right? But what I will say is this, right? Over the past 10, 15 years, single-handedly, the best investment you could have made was Bitcoin, right? So not saying the past is indicative of future returns, but when it's all said and done, is it a good asset class to own? Absolutely. It's a great inflation hedge, and it can be volatile at times, but it does give you the ability to share in the appreciation of something that is a once-in-a-generation technological advance, right? And so when I'm thinking about it, right, there's different ways that you can get access to it, right? You can own kind of the underlying crypto brokerage companies like a Coinbase. You could own different mining companies, but obviously we just talked about ETFs, right? And so I actually like ETFs, and I'll give you kind of the pros and cons when it comes to that, right? Because when you think about ETFs, right, for a person who doesn't know much about it at all, you don't have to be technologically savvy in order to buy an actual crypto ETF, whether it's Bitcoin or Ethereum, right? You can look at the BlackRocks of the world, the Fidelities of the world, and you say, hey, I'm going to buy that just like I buy any other stock in my normal retirement account, in my normal brokerage account. So the pros are, one, you don't got to be technologically advanced, as well as it's going to be less volatile. However, there are some cons, right? One being you don't actually own the underlying crypto, right? And owning the underlying crypto, you have seen the returns actually be better year to date. And another thing are their fees, right? Their fees associated with those management companies owning and buying the crypto for you. So if you're just trying to get your feet wet, maybe you could start with ETFs.
Sure.
But at some point, I would like for that person to actually buy the underlying crypto. And then this, and I give this advice with any form of buying any asset, you're not buying at one time and setting and forgetting it, right? You want a dollar cost average, and you're buying whether it's $100, $50, $1,000, $500, right? The same way you're, auto investing into your 401k, you want to start auto investing into crypto. That way you don't have to worry about, are we in a crypto boom or in a bust cycle?
Well, that's so great that you bring that up, because that's what I was going to ask. We keep talking about crypto hitting all-time highs. I'd imagine you don't think that means that people are too late to get in.
Yeah, listen, you're not too late, right? I think when it's all said and done, right, the best time to plant a tree was 20 years ago. The second best time to plant one is today. And so whether you're looking at the top stocks, like, oh, I missed my opportunity to get in it. Listen, if you start dollar cost averaging, you won't lose your opportunity, right? You take all the guessing work out of it. It's nearly impossible to time the market. Same with crypto.
What is dollar cost averaging for folks not familiar?
Dollar cost averaging, the idea is you're buying the same amount or the same dollar amount of this investment every month, every week, right? It's in intervals, but the idea is you're taking all the guessing work out of it. You set up auto invest, and I'm dollar cost averaging Bitcoin as well as dollar cost averaging when it comes to auto investing in my normal brokerage account for retirement.
There you go. We love it, Ross. Thank you so much. And thanks for bringing our audience that great investment advice. We really do appreciate you. And don't forget, folks, you can check out new episodes of Financial Freestyle. It's Ross Mack's podcast that airs on Yahoo Finance every Monday at 12 p.m. and across all platforms where you can get your podcasts. All right, moving on, we're going to focus on gold because futures have been on a tear this year for the metal, previously hitting all-time highs, but now hovering around 2,300, up over 1% on the day. So for beginner investors, is it too late to get in? Joining me now on this, we have Alex Ebkarian joining me from Allegiance Gold as the COO and co-founder. Alex, thank you so much for being here with us. So I would imagine you're going to have a similar answer to what Ross just told me, where the best time to plant a tree was 20 years ago or today. Does that same thinking apply to gold investing?
Somewhat. Well, first of all, thank you, Madison, for having me. Happy to be here to talk about the physical gold investments. The idea of gold is, number one, you want to be able to preserve your buying power. And then you want to look at the outlook. Really what's driving the value of gold right now are many catalysts. Obviously, interest rate hikes are around the corner. The recent economic data just validated that although inflation is dropping, what we're seeing is that the interest expense, it's costing a lot. So that's one. Number two, we have central banks doing two things. On one hand, they're de-dollarizing, and on the other hand, they're increasing their gold reserve. Also, we see the ongoing geopolitical tensions. And last but not least, we also have the potential recessionary risks. Since 2008, we haven't had any risk really in the market that was that much volatile. So with that, I think if you were to take a step back and ask yourself, where am I in life? What are my priorities? What's my time horizon? What are my risks? And you want to be able to think about how can I properly diversify, as opposed to having all my assets that are paper-based, potentially think about having some proper diversification with physical gold.
Well, talk to me about that diversification. How much of one's portfolio should be going to something like gold?
Well, you always want to ask your financial advisors for that. But specifically, what I've noticed is a lot of our clients ask us what would be a good way to potentially think about diversification. Like I said earlier, if you have all of your eggs in a single basket that is paper-based, then there is an inherent risk. So according to the World Gold Council and the In Gold We Trust report, what they've done is they've actually calculated over a long period of time what is a proper allocation. And what they found is that a 15% allocation is an ideal fit that does two things. Number one, it de-risks the portfolio. And number two, it enhances a risk-adjusted return. And one of the things we found from our clients over the years is that the ones that actually 5-6 years ago diversified a small portion, because they've seen the evidence in what gold has done to their portfolio, they are proactively increasing their allocation to a point where, just like the prior speaker mentioned, the same concept of dollar averaging.
Really quickly here in our last minute, I want to know how investors should be getting into gold if they want to. Should they be going to Costco for the gold bars? Should they be utilizing an app like Robinhood? How should they do it?
Well, there are 4 different options for the investor to get into gold. Number one, you have the mining shares, which is very much stock-based. You have the futures and options contract that's very complicated for sophisticated investors. You have the ETF, which is the GLD. And last but not least, you have the physical route, where you can have actual ownership. Each category has its advantages and disadvantages. What you want to look, if you're a first-time investor, ask yourself, what's more of a priority? Do I care about exposure or do I want ownership? When you think about central banks of the world, when it comes to gold investing, they actually prefer the ownership rather than exposure. And it boils down to simple factor. They want to eliminate the counterparty risk. They want to be in control because when you actually hold it, you own it. So as far as Costco is concerned, there are limitations of how many you can buy. And obviously, a lot of the investors are aware about that. It's a good exposure. It actually educates the people about the importance and how easy it is to get into gold. But what you want to look for is a reputable dealer that actually helps you on the acquisition, on the storage option, and last but not least, on the exit strategy in case you need liquidation.
All right, Alex, we're going to have to leave it there. Really appreciate you joining us. That was Alex Ebkarian. He's Allegiance Gold's COO and co-founder. Thanks so much, Alex.
Thank you, Madison.
Coming up, the question on everyone's mind is Kamala Bratt. We're going to discuss the Democrats' efforts to get out the youth vote and how it's going next. Do you know what Brat is? If you're on the Harris campaign, you definitely do. The Kamala HQ Twitter page rebranding itself into the Brat aesthetic that was originated by singer Charlie XCX. But the more serious question here is that effort going to have staying power to bring young people to the polls this November? For more on that question, we want to bring in Yahoo Finance's Rick Newman. Rick, do you know what Brat is? Let's start there.
Why are you asking me? I mean, I'm an old dude. But I have a pop culture advisory board, otherwise known as my 20-something kids, Robert and Jess, and I ask them about Charlie XCX, who coined Brat Summer, and they say she's legit, and my son described her as sort of halfway toward being Taylor Swift. So this is important. Whoa. She's a British pop star, and she tweeted herself, Kamala is Brat. So I guess if Charlie XCX is the expert, then she's right. Kamala is Brat. And I think what's happening here that's important is Kamala Harris is sort of organically gaining traction among, people interested in young culture and stuff like that. And she has also used Chapel Roan as a branding element for her campaign. Now, sing along with me, Maddie. It's a feminine phenomenon. That is what Kamala Harris says. So that's a Chapel Roan hit that's out there now. And just think about the timing. There's a song saying it's a feminine phenomenon. At the same time, we have now a Black woman who is the Democratic presidential nominee. So she is trying to tap into the energy that's out there among people. And because because the fans are doing it rather than this top-down effort by some clumsy branding company or something like that, it's likely to be effective.
Rick, now that you have quoted a Chapel Roan song, we can definitely say that you are Brat as well. So congratulations on that. You can put that in the family group chat. But I do want to end on how much staying power you think this is going to have heading into November. Is it going to convince young Republicans and young people who are further left than VP Harris to vote for her?
Before you even get to will she sort of steal any voters from the other side, I think the number one thing that both presidential candidates care about is just getting young people to vote in the first place, getting them interested and engaged, getting them to care. And I think, yes, this could make a difference. And, we're talking about possibly small segments of the electorate, but this is a close race, and it is going to turn on the margins. So, we all know that young people were just completely turned off and tuned out by two old guys when it was Trump and Biden. And now they have somebody who's a lot more interesting. So, yeah, I think this could have some staying power. And as I have been saying for some time, if you want to know who's going to win this race, tell me if Taylor Swift endorses a candidate in September and October, and then I'll tell you who's going to win. So watch for that.
There you go, Rick. Well, listen, that was so much fun and such important coverage, seriously, because I do think it could move the needle as we head to November. So thank you, as always, for joining us, and thanks to the group chat as well. All right, well, that is it for Wealth. I'm Madison Mills. Thanks so much for watching us. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up right here at 3 p.m. Eastern. You won't want to miss it. Have a great weekend.